Right now, buried in financial data that most people will never see, there's a signal flashing red. It's been flashing for 700 days straight. And if history is any guide, what comes next will make 2008 look like a warm-up. I'm talking about the yield curve inversion. And before your eyes glaze over, let me explain why this matters to you. Because in 1929, this same signal appeared before the market lost 89% of its value. In 2000, it preceded the dot-com bubble that wiped out trillions. In 2007, it warned us about the housing crisis that destroyed the global economy. And today, we're experiencing the longest inversion since the Great Depression. Not weeks, not months, 700 days and counting. The banks know what this means. The Federal Reserve knows what this means. But they're not exactly broadcasting it, are they? So, let's talk about what they're not telling you. First, what is a yield curve inversion? Imagine you're lending money to a friend. Normally, you'd charge more interest for a 10-year loan than a 2-year loan, right? Because there's more risk over a longer period. That's how bonds work too. The government pays more interest on 10-year Treasury bonds than 2-year bonds. Except when they don't. When the 2-year bond pays more than the 10-year bond, that's an inversion. And it happens for one reason. Investors are so worried about the near future that they're willing to accept lower returns just to keep their money safe for longer. They're essentially saying, the next couple years are going to be rough, but at least lock in something stable for the decade ahead. It's the financial equivalent of boarding up your windows before a hurricane. Now here's where it gets terrifying. This signal has predicted every major recession for the past 50 years. Every single one. But there's a pattern within the pattern that almost nobody talks about. The longer the inversion lasts, the worse the crash that follows. In 2007, the yield curve inverted for about 450 days before the housing market collapsed. We all remember what happened next. Banks failed, Bear Stearns vanished, Lehman Brothers disappeared overnight. The entire global financial system nearly imploded. Unemployment doubled. Millions lost their homes. But go back further, to 1929. The yield curve inverted for over 600 days before Black Tuesday. What followed was the Great Depression. Not a recession, not a downturn. A complete economic catastrophe that lasted a decade. Unemployment hit 25%. The stock market lost nearly 90% of its value. Banks failed by the thousands. Entire industries collapsed. Now do the math. We're at 700 days. We've already surpassed both of those historical markers. This isn't just long. This is unprecedented in modern history. And yet, turn on CNBC. Read the Wall Street Journal. What are they telling you? Soft landing. Resilient economy. Inflation is under control. It's like watching the band play cheerful music on the Titanic while water floods the lower decks. But let's look at what's actually happening beneath the surface, because the yield curve isn't the only warning sign. It's just the loudest one. Consumer debt in America just crossed $17 trillion. That's trillion with a T. Credit card debt alone hit $1.13 trillion, with average interest rates over 20%. Think about that. 1 in $5 that Americans owe on credit cards is just interest. Not the actual purchases, just the cost of borrowing. And here's the kicker. Credit card delinquencies are rising at the fastest pace since 2009. Auto loan delinquencies are spiking. Student loan payments just resumed after a 3-year pause, pulling another $400 a month out of millions of households. The consumer, which drives 70% of the US economy, is tapped out. But it gets worse. Corporate America is drowning in debt too. Companies borrowed trillions during the pandemic when interest rates were near zero. Cheap money, easy credit, no problem, right? Except now the Federal Reserve has jacked rates up to 5.5%, the highest in 22 years. All that debt needs to be refinanced at these new, much higher rates. Zombie companies, they're called. Businesses that can barely pay the interest on their debt, let alone the principal. There are thousands of them. When rates were low, they survived. Now, they're walking dead. And when they start defaulting, when they start laying off workers and closing facilities, that's when the real pain begins. Then there's commercial real estate, which might be the biggest ticking time bomb of all. Office buildings are sitting empty because of remote work. Shopping malls are dying because of Amazon. And all of it was financed with cheap debt that's now coming due. Regional banks are sitting on hundreds of billions in commercial real estate loans that are underwater. We got a preview of this in March 2023, when Silicon Valley Bank collapsed in 48 hours. Then Signature Bank. Then First Republic. The government stepped in and stopped the bleeding, but the underlying problem didn't go away. It's just festering. Here's what the banks aren't saying out loud. They're holding these bad loans on their books at full value, pretending everything is fine. But behind closed doors, they're tightening lending standards. They're building up cash reserves. They're preparing for something. Now, let's zoom out to the bigger picture, because this isn't just an American problem. China's real estate bubble, which represents nearly 30% of their entire economy, is imploding. Evergrande defaulted on over $300 billion in debt. Country Garden, another massive developer, is teetering. Millions of Chinese citizens who paid for apartments that were never finished are now refusing to pay their mortgages. The Chinese government is desperately trying to prop things up, but even their resources have limits. Europe is facing an energy crisis and potential recession. Japan is drowning in debt equal to 260% of their GDP. Emerging markets are getting crushed by a strong dollar, making their dollar-denominated debt unpayable. And in the middle of all this, we have geopolitical tensions at levels not seen since the Cold War. Ukraine, Taiwan, Middle East. Any one of these situations could spark a crisis that cascades through the global economy. So why 2026? Why not now? Because crashes don't happen the moment the yield curve inverts. There's always a lag. Think of it like this. The inversion is the warning light on your car's dashboard. It's telling you something is wrong with the engine, but the engine doesn't explode immediately. It keeps running, coughing, struggling, until finally it seizes up completely. Historically, the average lag between inversion and recession is 12 to 18 months. But remember, longer inversions mean worse crashes. And we're in uncharted territory with 700 days. What typically happens is this. The Federal Reserve, worried about inflation, raises interest rates aggressively. This inverts the yield curve and starts squeezing the economy. At first, things seem okay. Momentum carries everything forward. But beneath the surface, stress is building. Debt becomes harder to service. Borrowing becomes more expensive. Spending slows down. Companies start missing earnings targets. Then they start laying off workers. Consumer spending drops. More companies struggle. More layoffs. It becomes a vicious cycle. And then something breaks. One big company defaults. One major bank fails. One geopolitical event sends shockwaves through the system. That's the trigger. That's when everyone realizes simultaneously that the emperor has no clothes, and the panic begins. The smart money is already moving. Warren Buffett's Berkshire Hathaway is sitting on over $150 billion in cash, the most ever. That's not money waiting to buy stocks at current prices. That's dry powder waiting for a crash. Ray Dalio has been warning about debt cycles and loading up on gold. Michael Burry, who predicted the 2008 crisis, has been betting against the market. These people have access to information and analysis that makes our conversation look like kindergarten. And they're not buying the soft landing narrative. So what does this mean for you? If the pattern holds, if history is any guide, we're likely looking at a major market correction beginning sometime in late 2025 or 2026. Not a 10% dip, not a technical recession, a real crash. The kind that wipes out 30, 40, maybe 50% of stock values. The kind that triggers mass layoffs, bank failures, and economic pain that lasts for years. I'm not saying this to scare you. I'm saying this because the warning signs are there, flashing bright red, and pretending they don't exist doesn't make you safer. It makes you vulnerable. The banks aren't hiding this information because they're evil. They're hiding it because panic itself can trigger the crisis they're trying to avoid. It's a delicate balance. Keep confidence high enough to prevent a run on the system, but prepare quietly for what's coming. But you're not a bank. You don't have to play that game. Look at your own situation honestly. How much debt are you carrying? How secure is your job in a recession? How much of your net worth is tied up in stocks at all-time highs? How much cash do you have for emergencies? The crash might not come in 2026. Maybe the Fed threads the needle and pulls off a miracle. Maybe something changes. But the 700-day inversion isn't lying. The debt levels aren't lying. The historical patterns aren't lying. And when the crash does come, the people who prepared will survive. The people who didn't will be asking why nobody warned them. Consider yourself warned.